Traders, Greg here with a market update. So the big news locally here was the release of May CPI numbers yesterday. Market was expecting 3.8% and it came out shockingly well above expectations at 4%. Now, going into the data yesterday, the rates market priced only a 4% chance that the RBA would hike rates in August. Now, post that shocking number yesterday, rates market's now repriced a RBA hike in August, towards 40-50% chance now. So we have a live RBA meeting in August. So what does this mean for local markets? Okay, so firstly with the ASX, look, the ASX and stocks, they don't like rate hikes and they don't like restrictive monetary policy. So ASX, fell out of bed post that CPI number, and now we've seen ASX trade almost 200 points lower from the highs that we saw earlier on this week before the CPI print. Look, moving forward, I'd imagine that the ASX certainly would remain under pressure and we could certainly see much lower levels. So look, selling any sort of retracement, any sort of strength, rallies, etc. is probably the trade. I'd imagine the only thing in the short term that could possibly save the ASX is if US markets, namely NASDAQ and S&P, spiked up to make new fresh record highs and floated all the boats. Now moving on to the Aussie. Aussie did spike post CPI, had a run up towards 67 cents, but it was capped there. And what was capped by was more US dollar strength. So what we're seeing in the currency market at the moment is that the USD wrecking ball is back. So it's probably maybe not the best trade to express long Aussie via the USD. It's probably better expressed a long Aussie view on the back of a rate hike coming up via the crosses and via countries where we've already seen rate cuts and potentially more rate cuts. So Aussie CAD, Aussie Euro longs is probably the best way to express a long Aussie than, as we're saying previously, via the US. Now, sticking with the currency markets, big news that dollar yen has basically traded back above 160 and back above the last intervention highs, which was 160.15. We're currently up around 160.60. Interesting to note a couple of things. Firstly, that retail positioning in dollar yen is skewed heavy. Retail's actually net exposure is up above 85% net long dollar yen. So the path of least resistance for dollar yen certainly seems like it is north still. The only thing that really can save them obviously is intervention by the MOF. But I would say that in the short term, especially before the end of the week, and we're still waiting for US PCE inflation data on Friday in the US, I'd imagine that the Japanese probably will not intervene until they see that data. Obviously, because if that data is strong, we see a big sell-off in bonds and bond yields sharply higher, which will obviously drive dollar yen higher, and they'd certainly be wasting their bullets, coming in before they see that data. So I would say that if you are hoping for some sort of intervention or front-running intervention, possibly early next week after we've seen the US PCE data, so maybe Monday morning when markets are least liquid. Anyway, good luck with your trading and we'll check back soon.